subscribe now and press the bell icon. Never miss an update.
Yeah, so alimony is like, we all know that whatever the agreement has been between the spouses at the time of their, as part of their divorce or separation and all, we need to, one of the spouse has to give another one whatever has been decided by court. So prior to 2019, it was all taxable. And when it is taxable in one person's hand, it is also deductible with another person. It's not the case anymore. So now if you look into 1040 form, you don't find a line item for alimony or child support or anything. Because now it's supposed to be a personal transaction, not a taxable and all. Okay, so they're giving what are the conditions for alimony, that it has to be in cash or it has to be, alimony is like it's like an annual payment or periodical payment and all. It is supposed to be, it's pursuant to some kind of agreement, and it's terminated if the recipient dies. Then it doesn't mean the alimony will keep going on, right? Or if the recipient remarries also, I think a lot of times that this condition has been removed. Okay, then child support, again, child support are an exclusion from gross income. So if a client comes and says, well, I have to pay this much, and we have a very classic example. We have one of the clients, he keeps telling that to Tanya, I'm paying so much to my wife, as part of the agreement. Can I take all that as deduction? So that's not deductible. Whatever, amount that is, those are all personal expenses. Now they've been treated as personal, even child support and all. Okay. Property settlement, again, this is not a taxable transaction. A lot of times, like if they're having joint properties and all, so as part of the agreement, they'll have to, either divide a property or one spouse gets to keep it, and or whatever arrangement they may have. So again, those are specifically excluded from gross income, because it's their own property, their own, like, post-tax money has been used to buy that property, and now because they're separating, one of them gets to keep and another one has to lose that property. But it doesn't, like, I think IRS realized that those are all personal transfers. They should not be treated like a taxable and all. But the exclusion does not apply if the spouse is a non-resident. If we come across a situation when this property settlement is happening between a resident and non-resident spouse, then again we'll need to look into these rules thoroughly, because not necessarily they may get a relief on that. Then alimony recapture is like, there is certain rule. What IRS says, that if you're paying alimony not in a uniform way, then there is something called recapture, meaning we'll have to calculate it, and that gets added to the income of the payer, not of the recipient. So gift tax is also like that, right? Whosoever is giving the gift, that person has to give the gift tax and all. The same thing. So what they may do is, this happens especially with very rich couples and all, as part of their separation or divorce agreement, they may, they may structure it in a way that large property settlements are happening and all those things. So this recapture provision has been put up in the law, which is intended to prevent large property settlements from being treated as alimony. So large property settlements, one can ask, what difference does it make? Because both of them are excluded. But it may make a difference when, when you're thinking about the cost basis of the property. After a few years, if one of the spouse wants to sell that off, or if there is a depreciation they want to take, anything to do with that, it will, the basis will not be calculated correctly if if we put that up as alimony. So there could be two different kind of payments. One is the alimony payment, which is given to a spouse, usually paid every year. Second is one-time property settlement. At the time of separation, they may discuss and agree upon certain things. Child support is again different. That's a third category, you may call it. Now, what they're saying is it is intended to prevent large property settlements from being treated as alimony. So, if um, recapture occurs if payments significantly decrease in the second or third year after the divorce. So, if first year they're paying a very high amount, second year significantly lower amount, and third year further lower amount, then IRS sees a pattern that okay, first year you're trying to transfer more property. It's not really actually alimony; it's more of a property settlement, and then you're reducing it because alimony is supposed to be standard amount that every year just do this much only. They're supposed to take care of the maintenance expenses of the other spouse, uh, maintenance or support and those kind of expenses. So we cannot say that okay, first year I'll pay a lot and second year will reduce it, third year further reduce it. But then the lawyers may have this kind of agreement, and the spouses may agree on that, whatever. But the IRS will come and say, well, you can have any agreement you want. You can transfer $1 million, 100 million, or you can transfer nothing. We don't care about that. That's something very legal, and you need to just go to the court, or like if you have a dispute, go there. But as far as tax is considered, yeah, we'll put some recapture provision to make sure that in the name of alimony, you guys are not transferring big properties to each other. So there is a way to do that. You don't have to remember, you don't have to mug up all these things, but we need to know the concept that if this is happening, then there's something called alimony recapture, and we need to calculate that amount. That amount needs to be included as the income of the payer, not the income of the recipient. Quickly, we can go over this formula. So, alimony recapture amount for the second year is calculated as, we'll take what is second year alimony. It's 15,000 is the standard amount given by IRS, plus third year alimony, like second year minus 15 plus third year. And this is second year alimony recapture. First year alimony recapture is going to be again first year alimony minus second year minus second year recapture plus third year divided by 2 and all. We'll just go over one of these examples. It will be very clear once we go over that. But both first year and second year recapture are included in gross income of the payer. Okay. So, Shweta, do you want to give it a try explaining this? How second year, third year recapture amount is calculated?
I understood the first step, that is like in second for second year alimony
See,
recapture.
1 minute. I'll do it in a way that. Can you see it? Can you see my screen? You can still see it, right?
Yes, yes.
Okay, so here are the formulas. We just need to put formulas in this situation and see, like, if we can follow that.
Okay, so let us start with
So
second
we
year.
have to, yeah, we have to start with second year only because the second year alimony recapture amount gets included in the first year calculation. See, in the formula, they're saying second year recapture.
Right.
We cannot start with first year first. We have to start with second year. First, find out what is second year recapture, then put it in this formula for first year.
Okay.
Start.
So if we go with the formula, we have to, when first what we received in second year is 60,000, no, 40,000. And we have to deduct, that is 15,000 is the standard deduction plus third year alimony, that is 10,000. So 15,000 plus 10,000 is 25, and 40 minus 25 is equal to 15,000.
Okay.
So excess alimony that is received in year 2, right? That is
Correct.
15,000.
Yes.
And excess alimony in year 1 was, the formula is what? Second year alimony
First year
minus
alimony. This is the formula. First year alimony. So we are going to here see what is first
first
year,
year
second year,
alimony is
what is third year.
60,000.
So now you're going to go with first year, which is 60,000
Okay.
minus, put all these amounts.
Second year alimony, that is 40,000 minus second year recapture was, just now we have seen that is 15,000.
Mm-hmm.
Plus third year alimony as given in the question itself, that is 10,000.
Correct.
So 40 minus 15 plus 10, and that is subtracted. 60,000 is subtracted. No.
Right.
Yeah, divided by 2 and then 60,000 is subtracted. Then why are we adding again 15,000 here?
No, no, it needs to be. I think there is some problem here. It needs. Let me just refer to the. I
Because
don't know. I
second
had
year
lots. No, no,
admin.
there's some. I think it did not get printed here properly. So that 15,000, what they're saying, the formula is 60,000 minus 40 is second year alimony, minus 15 is the alimony recapture, plus 10, which is everything. This all we understood properly, right? It's all divided by 2.
Yeah,
Yeah.
so that is coming to 17,500.
Yeah. Plus, what they're doing is taking second year alimony recapture amount again.
First year and second
Okay,
year.
this is not printed here properly, but then you need to add plus again here 15,000, which is the excess alimony in year 2.
Again, we are supposed to add.
Yeah, yeah. How much does that come to? 40 minus 15 is how much? Plus 10 is like 35 or something, or how much is it?
Yeah, 35.
Divided by 2 is,
17,500.
and plus 15,000, 30
32,500.
less, I mean, deducted
60,000.
from
That is
15,000.
coming to 27,500.
Yeah, there's a printing mistake here in the formula. So, yeah, this probably we need to add this second year again. Okay, I'll confirm this from the other notes and I'll let you know. Maybe when I was copying it and all in the Word document, it got deleted. See, even this is not fully coming. It
Mm-hmm.
probably got deleted from here. Okay, but anyways, we understood the concept, right? We need to know when would this recapture provision be applied. So here we need to see this is the very important thing. We cannot just ignore this thing. The 60,000 paid in 1 year, suddenly it went down to 40, and year third is like, okay, this is such a big difference from year 1 to year 3. Now this person is saying, I'm going to pay only 10,000. So So what IRS is saying that there's something else being designed here. This cannot be the alimony. Alimony has to be a consistent amount and all, then it makes sense. But if this is declining, then you need to make sure you are adding something to the gross income of the payer.
Hello.
Okay.
Is someone saying something?
Okay,
Okay.
for this question, I think when they are calculating what is the excess alimony paid in every year, that's why they are, actually this 15,000, which we are supposed to deduct every year. Second year also 15,000. So when first year may minus ke against this 15,000 is added.
Yeah.
So
Yeah,
that's why this
maybe that.
15,000 is in the formula.
Right, right. That seems like a good logic here. Why we are taking 15,000? Because that's the recapture, right?
Yeah,
From year 2. And this,
yeah.
what Akshay is saying, that every year this adjustment need to be made, second year adjustment.
But we are anyhow adding that, no?
No, no, no.
Okay, we are
15,000, I think,
deducting.
Shweta, you were saying that it's some standard deduction, Nitika. First, is when we are calculating second year alimony, excess alimony, deducted 15,000 also.
Oh, wait, excess alimony.
Okay, 15 plus third year alimony.
Yes. So
So
So this
15,
15 is coming. Okay, no, 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 no. Now I understood. See,
yeah,
this 15, what they're saying is they take 15 every year as
every
like a
year.
standard
Hmm.
deduction. Okay, so this 15 is that for standard deduction. This 15 is for
Second
second.
year alimony, and the last 15 is a standard deduction.
Hmm. Understood. Yeah. So what we need to, like, the formula which is missing here is it should have like minus that 15,000 given by IRS themselves. I mean, plus this thing, so entire thing will get deducted from the first year alimony. So we are basically deducting this. This is what we are doing here also. We are deducting 15,000 from second year alimony. So we'll do the same thing here. We're doing our calculation and again deducting 15,000, which is a relief given by IRS. Clear? Shweta?
yes, yes, ma'am.
Okay. Let's go to the next one, annuity contracts. The portion of the amounts received under an annuity contract for which a statute does not provide an exclusion is gross income. So, anyways, annuity is again something, some investments that we make for which we're getting like annual returns. Those are called annuities. So, what they're saying is anything that you are that you are earning over, like, on top of the basic cost, that has to become your income. So, but then how to calculate that? Let's just go over this example. Tanya, can you read this?
Yes. Donna paid $1,200 for an annuity that pays $200 per month for an entire year for a total of $2,500. That is
24.
200 into, sorry, 2,400. 200 into 12 months. The percentage of each payment that can be excluded is 50%. 1,200 price of annuity divided by 2,400 total payments. Therefore, Donna may exclude $100, that is 50% of $200 of each payment from income for a total of 1,200. That is 100 into 12 months.
Right. Can you explain?
The annuity payment is 1,200 for the total payment, that is 200 per month. So that
No,
is
no, 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 no. It's
200.
not like that. Annuity, the way it works is she's making a full payment straight away, like saying that, okay, take money now, but later on, give me every month certain amount. So she paid $1,200 for an annuity scheme. It's like an investment scheme. And as per that scheme, they're saying that, okay, we'll pay you $200 per month back. Okay.
Okay.
So these are all kind of investment schemes and all. They may come up, instead of saying that, okay, we'll pay you straight away 10% interest, 15% interest. They may say that you pay all the amount up front, and every month we'll pay you certain amount back. And then obviously, if you add up all the amounts which are getting paid every month, it has to be more than the cost. Then only the person is getting some return. Right? If she pays 1,200 and then the annuity company is saying, okay, we'll give you $100 back for next 12 months. I mean, what's her gain? Why would she do that? So she is getting paid almost like double of what she has invested, but she'll have to wait for a year. But now, how do we take what is the income and all? This example is pretty simple because we know she's getting paid 2 times more. So 50% becomes her cost. So what IRS is saying that, okay, you deduct your cost. I mean, this is a simple example where it's only one time payment. Now think of it as like every year if she's making annuity payments, and every year annuity company, every month they're giving her certain amount back. It keeps getting complicated. So what IRS is saying that you see what portion, what you are giving to the company, what is that you're getting back for the full year, because the taxes are charged on yearly basis, not on monthly basis. So for full year, what is that you're going to get back, and what percentage you are earning on that effectively. So she's pretty much making 50% because she's paying 1,200 and she's getting back 2,400. So that's why 1,200 can be taken as a cost, which is definitely should not be added to the income because that's her own money that she has put in. Any excess has to be considered as an income.
Basically, the income will be only the extra part, right? The 1,200 that she's paying upfront, that is the only deduction she gets. Whatever extra is coming will be her income, correct?
Yeah, yeah, yeah. This is a simple example. If it gets complicated, that's it. They're saying that, okay, she'll get $150 every month for next 24 months. Then we have to calculate, because this is getting spread over 2 years, what is going to be the profit for first year versus second year, how much actually like she's getting back. Okay, here we can quickly see like it's all doubling up. Anyone has any questions? Okay, and this is a very, very standard phenomena. Whatever cost you're putting in, if you're getting it back, why would IRS want to tax you on that? It's only on the returns that one gets taxed. It's only on the income that comes from the investment. But the way annuity is structured is, it's not like, okay, you give me, $10,000 at the end of the year, I'll give you $12,000 back. There we know clearly $2,000 is the extra interest or whatever you're getting as a return. Here, the money comes every month as a standard amount. And so every month, if it's coming for 6 months in a year, and if it's another 6 months or another 12 months are falling in the next year, then we have to calculate how much income to take for first year, how much income to take for second year.
Yes, ma'am.
Okay.
Yes, ma'am.
Sorry. Okay, 401k plans, the employer contributions, they're not included in the income of the participant. Like a lot of times, 401k is all retirement plan. If you don't know about it, they're like not exactly like provident fund, but then you can say that this is more of a retirement plan, meaning it's a fund where you can put in your money, and 401k means retirement. So like after you reach certain age, then you'll be able to take it out, and till then the money stays locked with any of the bank or government and all, whichever company is running the plan. Okay, so what happens is the employee may say that, okay, fine, I want to put in every month from my salary, or every year I want to put in, say, $10,000 in 401k plan. Employer may come up with the scheme, or may come up with a plan saying that whatever employee is putting in, will also do a match of 10%. So if employer is putting in $10,000, employer may come and put in $1,000 in the name of the employee, in employee's account only. So later on, whenever employee reaches the age of 59 and a half, or whatever age has been prescribed, then after that, he can take out all the money, which is lying in 401k. And this all comes up as tax deferred in the year when the employee is putting money into 401k plan, or employer is putting, no one is paying taxes on that. It's actually the income of employee, but employee is not paying taxes. Why? Because this is the incentive IRS is giving, that you put money for your savings. Otherwise, people will not put money into savings, and then the whole nationwide problem starts. They all grow sick, as they grow sick and all. As they age and all, they will get sick, and then government has to spend so much money on medical and other facilities and all, right, or take care of them, or then government has to keep constructing all these old age homes and what other all kind of stuff, facilities that they need. They cannot be just left like that. So that's why they are forcefully or incentive, giving some kind of incentive, that you put money into 401k plan, that is your own money, you'll be able to take it only when you reach certain age, and that will take care of you after retirement years. But those are not included in the income of the participant.
But it becomes taxable after they withdraw it, right? After attaining the age.
Yeah, so that's why we call them as tax deferred. These are not tax free. You can keep deferring them for 15, 20, 30, 40 years. And whenever you take them out, that is the point of time it becomes taxable.
Okay.
Okay. Again, this all gives benefit, right? So when the taxpayer reaches 60 year of age, probably is not making as much money. If it's a regular job, maybe he's left the job, so the income will come down, and is not making as much money as what he used to make when he was like probably 40 or 50 years, maybe like 50, 55 years of age. So the bracket will come down. Instead of paying 30%, he'll probably pay only 10% when he takes out the money. So even though it is taxable, it may result into tax savings. And more than that, it is like a forced savings. So they have some money, and that's why IRS put a restriction that you cannot take it out until you reach the retirement age. Otherwise, people in US and all, they may just take out money anytime they want to, and they have like so much dependency on loans and credit cards and all those things. So they may want to just use that money. Savings are generally not that high. So in order to, encourage that, they've come up with these plans. And in order to discourage that they do not take out money prematurely, IRS will also put a penalty of 10%. That if you take this out before you reach certain age, pay the tax. Tax part is there, but you also pay 10% extra on that. Okay, so people would at least think, 4 times before taking out that money, that do they really need it? Or otherwise they'll keep taking out. It's like, hey, I want to go on vacation. Okay, fine, I don't have money in bank account. Let's take it from 401k. Okay, or want to buy a TV, or want to buy a big car. I don't have money. Let's take it from 401k. I mean, these funds will be used for all of the other purpose which they are not meant to be. Okay, so let's go to next one. Income from life insurance and all. Generally, when the person dies and the proceeds are given, the life insurance proceeds, they're not taxable. That's a rule we all can remember. Those are not taxable at all. It could be like into millions of dollars. It could be like $5 million, $10 million. The insurance company may give that money. That's not treated as an income. But obviously, if there is any interest paid on the proceeds of a policy, the interest amount will come up as a gross income. If the insurance company is delaying the payment for some reason and all, then there might be a clause for there might be a clause for paying interest. Then obviously the interest has to be taxable. Then any employer-owned life insurance contract and all, like usually the amount excluded, like usually those amounts are not treated as income of the employee. Okay. The income exclusion rule does not apply to member of the insured family, to any individual as a designated family. This is all about employer-owned life insurance. So the rules are different here, but generally the insurance money is not taxable. Let's read this. Amount excluded from gross income of an applicable policy holder with respect to an employer owned is not to exceed the premium excluded from the gross income is not to exceed the premium and all. Again, these are all for the contracts after 2006 and all. And yeah, so what they're saying is if it's an employer-owned life insurance, that means the premium is not paid by employee. Employer is paying all that thing. So the that up to, I think what they're trying to say is up to the premium amount, it may be taxable, but generally it is not. The income inclusion rule does not apply. So again, it is not considered to be an income, even if it's being received by anybody else and all. Okay. Anyways, we'll, it's not that, it could be a bit complicated, but what we need to remember is generally life insurance and all these is not going to be taxable. Debt discharge, we have seen that earlier also, yesterday also we saw that if any debt is being forgiven, then it may be considered as an income for the debtor, because now the person doesn't have to pay it back to the creditor. So usually a form 1099-C will be issued. 1099-C is for cancellation of the debt, and that needs to be added as income of the debtor. But if the creditor cancels the debt, then a 1099-C form is to be issued, and debtor must recognize this as an income and all, and we'll have to report it on 1040 like any other income. There's a box called other income, so it needs to be included there. And so generally a corporation has gross income from discharge when it satisfies. So if a corporation has taken up a debt and the corporation says, okay, we are not going to pay it back, but we will issue you more stocks to the creditor, then that becomes the income of the corporation. So what they're doing is they're taking all that money, they're converting it, and not paying it back through cash, but by issuing its own stocks. The amount of gross income is the amount by which the principal of the debt exceeds the value of the transferred stock, plus the value of any other property transferred. So we have to see what is the fair market value of the stock which is being issued against the debt, and any extra, like any amount above the principal, will be considered as an income. Okay. So when we see a situation that there is a debt of say $100,000 sitting on the books of the corporation and they're not paying it, usually it would be convertible debt and all, right? A lot of times we know this, we come across this thing that this is a convertible debt which is being issued. Some point of time it gets converted to equity. Then we definitely have to see what is the value of the debt. Say it's $100,000, or maybe over the years there's some interest that gets accumulated, so it becomes 110, 120, and that amount is being converted into stock. So we also have to see what is the value of the stock as of that day. And there are all these valuations which are being done. 409A valuation is there, or other valuation which is being done by an independent authority. And based on that, we'll have to see if the valuation is very high. Okay, then there might be a hidden income element there. Okay, so that means you're giving more, but then that becomes like, the corporation has to pay that amount as income. They have to pay the taxes. So we have to see the amount by which the principal of the debt exceeds the value of the transferred stock, or the other way around. So if the debt is for $100,000, you're giving stocks of only $50,000, then $50,000 becomes the whatever income of the company. Okay, is that clear? Shweta, Tanya, Raksha?
Yes,
Yes,
ma'am.
yes, ma'am.
And if the creditor himself gratuitously cancels a debt, they themselves say, well, you don't have to pay anymore and all, fine. The debtor is ready to pay. But they themselves, if they cancel it, then the amount forgiven is treated as gift. So we have to see what are the gift tax, rules and all, and how much of gift is excluded or how much of gift will be taxable. That's a different rule completely, but we have to treat them as gift. There's certain exception here. Gross income does not include discharges, that if the company is going through bankruptcy, or when the debtor is insolvent but not in bankruptcy and all, then we have to consider all these things. In that case, it will not be considered as an income, because like there is a real financial situation which is happening there. So we cannot say that, okay, now you add that back to the income also. So those are the areas where IRS will give some kind of relief that, okay, they're already going through bankruptcy and also we don't want to add up, saying that, this becomes your income. And this is very common during bankruptcy, that corporation or whosoever is going bankrupt, they will not be able to pay 100%. So there will be some settlement done, maybe like 20%, 30% will be paid back. But the rest of 70% will not come up as an income. And when and this will not be considered as an income, so it will be excluded. So when these kind of things are happening, what they're saying under D1 to 3, okay, under exceptions, if these things are happening, then how do we adjust that amount? What IRS is saying, you go in this order, that maybe NOLs will get impacted, or maybe some business credits and all those things. We'll have to see. Like, it will depend on situation to situation. But then what IRS is saying, if you're having the liabilities, if they're written off, then, if you have to reduce the tax at or make changes to the tax situation, then you follow this order. This could be a bit complicated for now to understand how will it impact NOLs, or how will it impact basis reductions or capital loss carryovers and all. But then it's quite possible that they're giving, some properties like are written off and all, so that may impact the capital assets. So we'll have to see what is the basis calculation, what is the basis adjustment on the properties and all. And any one more exception is there, which is related to principal residence indebtedness. Principal residence meaning, obviously we are talking about individuals only here. Corporation will not have a principal residence. So a lot of times it happens that the real estate market has really fallen down, and the person who has taken a mortgage and all, they're not able to pay it back. So the banks may have to, or the mortgage companies may have to come to an agreement, maybe saying that okay, fine, we'll write off certain amount, and or they, instead of losing everything, they may have to, and that's also very common. So in those cases, it will not be considered as an income to the individuals. Why it will not be considered as an income? Because when they got the money, again, that was not like an income to them. It all went towards the cost of the asset that they bought. So now, how will they adjust that? If any of the mortgage loan is written off or it has been forgiven, how will they adjust it? They'll have to see what is the impact of that on the basis of that asset which was bought. Maybe the asset was bought for $5 million, and maybe there was a loan of $2 million on that. Now suddenly the value of that asset itself went to $3 million. The taxpayer may not be able to pay off that amount on that, or whatever. That might not be the situation. So we'll have to adjust the basis. The basis will be 5 million, because that at that point the transaction happened on 5 million only. But if the loan is written off for $1 million, maybe the basis goes down to 4 million. That will have an impact on depreciation if you're taking. That will have an impact on the future sale of that property and all. But what they're trying to say is to give relief to 1040 or individuals. They say that okay, any of the principal residence loans which are forgiven will not be considered as an income. Okay, principal residence, only principal residence. But if you have just given a general loan to a friend, say $30,000-$40,000, and the friend doesn't want to pay it back, and and you have to issue a 1099-C that okay, I'm going to cancel it. That means that friend has to report that as an income. Or if you're telling your friend that hey, you're a very close friend, fine, I don't even want that money back, then it becomes a gift. So the gift tax rules will come up. Okay, so when a property is sold to the lender, Form 1099A is issued. So 1099A is also very common form. We will see a lot of times that, we'll get these forms. That's how we figured out that there has been a sale of the property. Obviously, we saw what is 1099C. And if the sale of the property and the cancellation of the debt, if they are occurring in the same year, then we just have to issue a Form 1099-C. But they don't have to occur in the same year. It's quite possible that the loan is cancelled before and the sale happens in the next year and all. I mean, usually sales and all, they don't happen immediately and all. So they don't even have to happen in the same year. So if they're happening in 2 different years, then first, like let's say the sale is happening, or maybe let's say the debt is cancelled, then 1099-C will be issued. Maybe next year you're selling off the house, then 1099-A would be issued. The property is sold to the lender, then a 1099-A would be issued. When a cancelled debt is a non-business debt, wait a minute, it's a non-business. Okay, this is the Mortgage Forgiveness Act. Any other non-business, even though this mortgage is also non-business and all, but any other debt which is a non-business debt which has been cancelled, it has to be reported as other income. We have already seen that, like, the friend example that I gave, that if they're writing off the debt or canceling it, it becomes income. But the Mortgage Forgiveness Debt Relief Act, this is a full act that the IRS, sorry, the Congress has passed in US. And what they're saying is, if there is a decline in the home's value, or if the taxpayer financial situation is really bad, or if the entire economy, we can see that there is a drop in the house prices and all, there's some kind of economical situation, then do not add that as an income for the individual, because unnecessary they go through this huge tax burden. First of all, they don't even have money to pay the mortgage, and on top of that, if IRS comes and puts more taxes on it, like, how are they supposed to pay? So this relief is only given to the individuals, not for the companies. Companies are meant to make profits. So they'll have to, the IRS is not going to be that lenient with them. They have to be strict with them that you have to pay taxes. Whether you have the money or not, that's like your hassle, go and figure out. But in the case of individuals, there has to be some relief given to them. So any discharges of debt up to $2 million can be excluded. That's what they say. Sakshi, can you read this? Example 2.7.
Yes, ma'am. The amount of debt forgiveness as a reward for early payoff of a home mortgage is other income reported on line 8 of Schedule 1, Form 1040.
Yeah, so now we are thinking, oh, there is a debt forgiveness. I mean, we just discussed that this is not taxable, but now here this example is saying that it is an income which needs to be reported on line 8 or whatever. But let's read it again. What are they saying? The amount of debt forgiveness as a reward. It is given as a reward for early payoff. What company is saying that, okay, you have to pay off your debt in, say, 10 years, but if you pay it off in next 5 years only, we will forgive some things and all. Okay, we are going to give you kind of reward. That becomes an income. And there is no such they're not talking about any such thing like there is a financial crunch for the taxpayer, or there is a decline in the value of the home, and that's why the debt is forgiven. None of this condition is applicable. So this is just a reward. This is an extra income given to the taxpayer. Here there is no need for IRS to give them a relief. This probably the taxpayer has enough money, that's why they're doing an early payoff, and so they might as well pay taxes also. Are we clear? Like Vinita, Muskan, Rohit from Indore, and Rohit from Ujjain both. Okay, how about Vanna, Bhavani, Hemant?
Ma'am, when the debt is not paid before the time or it exceeds the time limit.
No. I'm talking about mortgage. When does the debt forgiveness, or whatever the debt which has been forgiven, it does not count as an income for the debtor. Usually, if a debt is cancelled, that becomes income for the person who got the loan, right? Because that's the free money that they're getting. They don't have to return it back. So it kind of becomes an income. But in what situation it will not be considered as an income? And I'm talking about only about mortgage debts which are being forgiven. Okay, anyone who knows this answer?
Let me try. If due to economical conditions, if the value of the property is reduced substantially, and the person who has taken mortgage loan is not able to pay the loan amount, and it is forgiven
Right.
by the lender, or due to his financial conditions, or something is not able to pay it.
Correct. So, I mean, are you guys all confused why we just like talked about it? that if there is a decline in the home value or taxpayer financial condition, this is a relief that IRS is giving. So, okay, another question. What form is issued when the debt is cancelled? Anyone can answer this.
In 1099C.
Okay, and what good. And if it's not cancelled, it's just forgiven because the creditor wants to be nice to you, then how do we report it?
Tax as gift.
As a gift.
As gift. Yeah, because it's my birthday, forgive my loan. So that becomes a gift, right? Okay. So we need to be aware of these forms and all. Usually 1099C will be taken up as an income on other income. We will have to report it if you see this form. Or if we have a client who is coming and saying, well, I gave this loan to my friend, I don't think I'm going to get it back, whatever, all those things, then we need to tell them, issue a form 1099C, because that person has to report it as an income. If you don't issue, IRS will not come to know. So, finish off the transaction from your side, whether then at least from their side they're done. Because if IRS comes to know that you've given a loan and not issuing a 1099C, there will be a penalty on the person who has given the loan, because they would think that this person is intentionally hiding the income from IRS. There would be a penalty on the other person also. That person also has their own responsibility, that they should be, even if they don't receive a 1099, it's the responsibility of the taxpayer to report any income which has been earned, whether or not they get 1099. So right now, last week, you spent so much time like issuing all the 1099s. If we don't issue, doesn't mean that this is not an income. The other person has to have their also accounts properly done, and they have to report that as an income. But if we don't issue it, there will be a penalty on us as well, because IRS is saying, as a business, you are supposed to tell us. If you don't tell us, there will be some penalties for you also. And obviously, if the other person does not report it as an income, there will be higher penalties on them, because they are completely evading the tax. Here we are not following the compliance rule, so there are going to be penalties. They are not going to be as strict as what it would be on the person who has received an income and chosen not to report it to IRS. So we need to understand, a lot of times client will come and say, well, can I claim this as a loss? I have given this amount to somebody and all. If the amount has been given to a US person, we always need to tell the person that when you're doing any transaction with anybody, make sure you're getting social security number for that person, or their name, address, everything, before you transfer any money. Because if that person stops responding, disappears, how would a form 1099C would be issued? Without social security, we cannot do anything. So it's very important, even if it's income or any money, that's why we say that, okay, get form W9, whether we need to issue a 1099, all that's secondary. But the form W9 has to be there in the record. Because if we don't keep form W9, and if IRS starts auditing, they may say that, hey, we see $100,000 of contractor payment. You issued 1099 only for $50,000. So we are going to penalize you for that. We may go and we may tell them, well, we did not issue 1099 for remaining 50, because see, you see all the payments are going to some ABC Inc., XYZ Inc. So these are all companies. We don't need to issue. What will IRS say? Fine. Okay, if you don't need to issue, give us the proof. Show us form W9 signed by the vendor that they are a company. And if you don't have form W9 in record, worse, they may also go to the extent saying that, okay, we don't know whom you issued it to, ABC Inc. We don't know what that company is, you don't have anything in record, so you better pay 30% taxes on that. This happens a lot. This may also happen for any NR payments, any non-resident payments going out. IRS may say, why there is no withholding? 30%. There has to be withholding, and you pay that to IRS. So we'll have to be, how do we prove that no withholding is required? by properly furnishing them Form W8 Ben. If we don't have that form, whatever we say, they may not agree. And in the end, the company who has already paid 100,000 to the creditors, they may have to pay 30,000 again to IRS plus interest penalties. It could go up to 40, 50,000. So it's very, very important to collect all W9 forms, W8 ban. We need to tell to the client that we see, you have made payments to so and so vendors. Make sure you're having W9 forms. At least we should put it in writing and send it to all the clients. If they don't get it, we should be able to prove that we have given them this advice. If they don't get it, we cannot be after them. But then at least if they're getting audited by IRS, we can tell them that we have already warned you. And a lot of times I've seen these kind of audits that then IRS will send a letter, okay, we want to audit all your vendors, to make sure you're issuing proper forms and all. Then at that point of time, maybe the audit will come for some year which is like already gone, like some 4 or 5 years back. They'll start they'll pull up some old year and they'll start auditing. They can go back up to 7 years. So they can pick up any year in last 7 years. Then what happens? Half of the time people don't even remember, oh, I don't know which company is that. Why did we hire them? Why did we pay them? Then we start going through all the email communication, try to connect with that vendor, ask them that, can you give your W9 now? And all those things. And it all becomes a hassle. So non-issuing 1099 is only $25 penalty. But if they start auditing, we may have to pay like 30% on top of it. Because IRS just want to make sure somebody is paying taxes on it. We should be able to prove that it is not our income. The other person who's received that money, they should be paying taxes. If you don't have W9 form, we will not be able to prove that. Then what they say, they'll say, we don't know who this non-resident is. You must have given the money to somebody. We don't know all of that stuff. Neither we are going to go to India to catch that person. But you are a US company, so now you pay 30%. Okay. So let's go to the next point. Any student loan forgiveness, usually it is not considered to be an income. And especially if it's a federal, state, local government, like, some government has issued a loan and all, and they decided to forgive it and all, it doesn't come up as an income. Yeah, so it is excluded from gross income. Social security benefits, this is something, again, social security is not considered to be a taxable amount. Social security, what is social security? Like, can anyone explain what is social security? Tanya, can you explain? So a lot of our new joinees will not know what is social security. Is Tanya there?
It's basically a guaranteed payment by the government to individuals for their healthcare and income after retirement.
Yeah, or in case they get disabled, or the earning member of the family passes away, to take care of the other members of the family. So social, we always see whenever we are running a payroll amount, we see there's something called social security tax. Every month, whenever the person gets paid as an employee, 7.5% is paid by employee to IRS in the name of social security taxes, and same amount is paid by employer to IRS. So if they are working for, like, say, 30, 40 years throughout their life, 50 years, they are collecting that amount as social security amount. And it goes against their social security number. It sits in their own fund. You can get a letter from them, or you can go and talk to Social Security Administration and ask them, like, how much have I paid throughout my life for Social Security. and how much has my employer paid for it. Okay, so this is like a fund which has been kept by US government. This is not IRS fund. It's a US government fund. Okay, anything that happens in the family or at the time of retirement, or if a person falls sick or disabled permanently, temporarily, death and all those things, so those benefits are given. It again depends. Somebody might get $2,000 a month from the US government, or someone may get only $500 a month. It all depends how much they have put in into their account. So if a person is having a salary of, say, or average salary of, say, $400,000, $300,000, obviously that person is putting in more amount as social security, right? Because it's a direct percentage of the payroll. Versus a person who is earning lifelong, his salaries had been only 20, 30, $40,000. So that person would be putting in less amount in that fund or in that corpus fund. But it's not like you cannot say that, okay, over a period of time, I have put in $1 million, I need $1 million back from IRS, from US government. Doesn't work like that. So what they do is they will see how much you have put in, a percentage of that they will give it, because this money is meant to be used for the entire public. So think of it as like rich people are paying taxes, so that this money can be used for everybody. So we cannot, it's not like a 401k amount where you can say that I have put in $100,000, entire $100,000 is mine. Yeah, 401k is very personal in nature. You can take out anytime you want to, after you fulfill certain conditions. But Social Security is not like that. But those benefits are given only if something goes wrong in the life, or if the person has reached certain age. So what IRS is saying that we will not put that up as a taxable amount. But if your income is exceeding certain thresholds and all, there may be portion of Social Security amount that will come up as taxable amount. And this is what the calculation is happening here. Okay, we will go through that later. But what they're saying is, like, if your income is above certain level, then your inclusion may be up to 85%. So if you're getting $10,000 as Social Security, maybe 8,500 will come up as taxable amount. If certain conditions are satisfied, that means if your other income is very high, because the whole intention is that Social Security benefits should be given to people who are needy, who really need that money. If rich people are taking out that money, then why should IRS give benefit to them? Okay, so they have put in certain conditions that if your income is above certain level, maybe 50% will come up as taxable to you, or maybe 85%. But generally, this is not taxable at all. So if you get a question, do I get, like, I'm going to get social security benefits?
What if the rich person is disabled?
Yeah, even for the disabled person, like there is, so if the disabled person also has some other income, which is quite high in nature, then the rules maybe we'll have to go through this rule. What is their adjusted AGI and all those things? Okay, we'll go through this in the next class, how this is calculated and all, because this could be a little bit complicated exercise. But again, there are a lot of softwares for it and all. We don't have to manually, we never manually calculate all these things. Okay, we don't manually calculate all these things, but we need to know that generally it is not taxable. But if you fall into a higher tax, higher income group and all, and if you satisfy certain conditions, if you don't satisfy, then it may come up as a taxable amount. Once we go through this example, then it will be pretty clear. Again, we'll just finish off these small things. Railroad Retirement Board and all, these are like our railways, Indian Railways and all, where they will have some special benefit. Like if people have done so many years of services and all, then this is not taxable and all. Okay, so retirement annuities and all. illegal activities. Whether the activities is illegal or legal, IRS doesn't care about that. That is something the police will care about. Okay, or the crime department will look into that, whether you're doing something legal or illegal. But what IRS is saying, we don't care. You can make illegal gains, whatever you want to. Just make sure you're paying taxes on it. Income from illegal activities is also considered as a gross income. You cannot say, well, this income is illegal, I don't want to pay taxes on it. Scholarship, usually scholarship amounts are not taxable at all. They are usually given to students, those who are deserving, or to take care of all their educational expenses. But if the scholarship is way too high than the actual expenses that they're incurring, then it should really trigger in our mind that what is it, like in the name of scholarship, are they just pushing out some money? I mean, is this a real scholarship? Because scholarship is supposed to just cover up the education expenses. Okay, I mean, small amount here and there is fine. Or if is the person like doing some, the student is doing some work under the professor in the university, or maybe doing some research work, and all this research work is very, very common in US universities. Every student is working there. Every student is working 10-15 hours a week besides their studies, and they also earn some money. So, but those should not be termed as scholarship. Those are called RAs and TAs and all, like research assistantships and all. Those are different kind of income, and those are taxable. But if the university is saying we'll give you scholarship, actually there is a condition in the scholarship that you have to put in so many hours of 20 hours of work and do this, do that, and all. Then it is not a scholarship. You may call it scholarship, but it's actually a kind of employment contract. Okay, but generally it is not considered as taxable. Okay, we'll just go over this example, then we'll close on it, and we'll continue tomorrow for the prize and award, because this section is a bit lengthy. Yeah. Unemployment benefits are usually taxable. And we see a lot of times that, what is that form called? Anyone remembers for unemployment benefits? Shweta, do you remember? Tanya, you may remember, so I'm not asking you. We have seen this a lot of times.
Seen it. We have seen it, but I'm unable to recall right now.
1099. It's 1099G because it is given by, if it is given by federal or state program, then it's called G. G meaning government. 1099G, when we see, we know that those are all unemployment. If the person loses the job, they may also apply for unemployment benefits, and the government, state government or federal government, they usually pay certain amount every month until they get the job back.
Is it FUTA, FUTA?
FUTA and SUI and all, those are all taxes. Those are all unemployment taxes only. So that's how, when these taxes are paid, that's how the government comes up with these huge corpus funds. And if somebody, then if they lose their job, then they dig into that fund, and then they start paying the money. So they're collecting a small percentage of tax from everybody in the name of unemployment taxes, which is FUTA, which is SUI, or it could be some other name and all. Every state will have that thing. Right? A state will not get its own money. It will just come from taxes only. So in the end, like, people are paying for it. But those are all mandatory taxes. Then one can apply for those. Yeah, but that is what is the intention behind charging FUTA or SUI and all. SUI is like state unemployment. What is it, Tanya? Insurance amount or something?
Insurance, yeah.
Right, insurance. And FUTA is federal unemployment taxes or something. Okay, so let's go over this. This one we'll do later. We'll just go over the scholarship question. Who wants to read this? Vandana?
Yes, ma'am. Laura received a scholarship of $2,500, and as a condition for receiving the scholarship, Laura must serve as a part-time teaching assistant. Of the $2,500 scholarship, 1,000 represents payment for teaching. Assuming Laura only uses her scholarship for qualified education expenses, Laura will be able to exclude $1,500 from income. The $1,000 she received for teaching is taxable and must be included in income.
Yeah, so they are saying it's a scholarship of 2,500, but there is a condition attached with it that she should also serve as a part-time teaching assistant. That's not every student will not do that. If the condition is like, okay, the student has to attend every class, there has to be a minimum attendance of so much and all that, those conditions are still, reasonable. But here to receive the scholarship, they're saying that she has to serve as a part-time teaching assistant. That means she's doing a job under some professor and she has to do all that thing. Work as an employee or contractor and all. So the $1,000 which represents payment for teaching and all, that is not going to be considered as scholarship. So that has to be considered as a taxable income for Laura, and it has to be included in income. Okay, clear?
Yes, ma'am.
Anyone else has any questions? Otherwise, we'll wrap up here.
I have three questions.
Wow. Okay, go ahead. This is a big chapter.
No, first question is like social security taxes. If someone is not getting 100% social security tax paid by that person throughout the life at the time of need, then is it considered as donation or something given to government to help the
No, no, no,
people
no,
of
no.
society?
That's a very brilliant idea. No, but you don't get any donation benefit for that. You don't get
Let's
any
try now.
charitable deduction. Yeah, you may.
Mm.
In reality, it might be a charity. You just give it
Mm.
and you get it. Again, there's so many discussions going on social security. People think they don't know. Like once they reach retirement age after 20, 30, 40 years, whether US government will even have money left for social
Mm.
security or not. They may not be even able to pay it.
Mm.
So there's like because of all the deficit which is happening and all those things, there's a big, all this like
Debate is
activists
going on.
and all these activists are saying that this is the, government should stop that. Forget about people those who live in US.
mm,
I mean, US citizen or green card holder, even people those who go there and work on visa for 10 years, 15 years, 5 years and all, they also have to give social security.
mm,
And once they return back to their country, they become non-residents of US, and non-residents don't get social security benefits.
mm,
So for
mm,
them, they're just giving it away for just giving it away as a tax.
mm. Okay.
They don't even get any benefit. The benefits are given only to US residents.
The second is if some student gets discount on the fee because of some conditions, say 50% fee is not payable or 90% fee is not payable. Will that be considered as income?
No, that will not be considered. Usually, I mean, that is considered as a scholarship only. Scholarship is what people say, oh, I got 50% scholarship, 30% scholarship, and all. Because that is directly connected with the fees, with the
Hmm.
education expense. It's
Hmm.
not something they're getting on extra on top of,
Hmm.
education expenses reimbursement.
Okay. So it will not be considered as income. Okay.
No.